Dive into something that sounds, well, kind of impossible. We're going to talk about how one single asset, like a machine or a building, can have two completely different legally correct values at the exact same time. Now, this is a huge headache for global companies, but the solution, as you're about to see, is actually pretty brilliant. So, right off the bat, you're probably thinking, how on earth is that possible? Is this some kind of shady accounting trick? No, not at all. This is a fundamental requirement for any business that operates in more than one country, and it all boils down to the different rule books they're forced to play by.
You see, a big global company is kind of living in two different financial worlds at the same time. On one hand, it has to follow the local accounting standards of its home country, for taxes and local regulations. But at the same time, it also has to report its finances using international standards like IFRS for its global investors. And here's the kicker. Those two rule books often say very different things about what an asset is worth.
Okay, to make this all make sense, let's get out of the abstract. Let's follow a real-world example. I want you to meet Kevin and his brand new excavator. So this is Kevin. He works for the bike company, and they've just bought this big, shiny new excavator. His job seems simple enough, just get it recorded in the company's financial system. But Kevin's a smart guy, and he knows there's a complication hiding just around the corner. And here's the exact problem he's up against. He knows that the way this excavator loses value over time, what we call depreciation, is calculated differently depending on which rulebook you're using. So why the difference? Well, think about it. The local government might say, hey, write that thing off over 5 years. We want to encourage you to invest. But the international standards, they're all about economic reality. They might say, nope, that machine is going to be useful for 7 years. So that's the number you have to use. See, same asset, totally different rules. So what's a system like SAP supposed to do here? Does it make Kevin pick a side? Not a chance. The solution is actually pretty genius. Instead of choosing one value over the other, it creates parallel financial worlds, allowing both to exist at the same time, perfectly accurate and totally automatic. The magic behind all of this is a concept called valuation views. Now, the easiest way to think about this is like having different pairs of glasses. You put on one pair, your local standards glasses, and you see one value for the asset. Then you swap them out for your IFRS glasses, and you see a completely different value. It's the same excavator, you're just looking at it through two different but equally valid financial lenses. And this is where it gets really slick. When a financial event happens, let's say it's the end of the year and it's time to post depreciation, Kevin only has to do one thing. He makes one entry. That's it. The system takes that single action and automatically calculates and records the financial impact in both valuation views. One trigger, two distinct outcomes, recorded perfectly in parallel. Pretty cool, right? Okay, enough with the theory. Let's jump back to Kevin's excavator and see what this actually looks like when the numbers hit the books.
And there you have it. Check this out. After just 1 year, the book value of that one excavator is already different. Under the local accounting rules, its value has dropped by one amount, but under IFRS, it's dropped by another. Two different values, both 100% correct, for the exact same piece of equipment. That right there is parallel valuation in a nutshell.
And this whole process of juggling two values isn't just a one-time thing. Oh no, the system keeps track of these parallel lives for the asset's entire journey, from the very first day it's purchased, through every single depreciation run, month after month, year after year, all the way to the day it finally leaves the company. And eventually that day does come. The excavator gets sold and it's time to retire from the books. And again, the system handles it like a pro. It automatically calculates the gain or loss from that sale based on both the local book value and the IFRS book value. This means the final reports for both the tax authorities and the investors are spot on. So, we've followed Kevin's journey from start to finish, but let's zoom out for a second. Why does any of this really matter? What's the big picture takeaway here for a modern business? Because look, this isn't just some neat accounting feature. It's absolutely fundamental to how a global business operates today. The benefits are massive. First up, global compliance. You're playing by the rules, everywhere, no exceptions. Second, accurate reporting. You can confidently hand the right set of numbers to anyone who asks, whether it's the government or Wall Street. And maybe most importantly, better decision-making. The people at the top get a complete, multifaceted view of what their assets are truly worth, helping them make much smarter strategic choices. And all this leaves us with a really fascinating question to chew on. We've seen how a single asset can have multiple truths about its value, and all of them are legally correct. So if a company's assets are represented by all these different valid numbers, What is their real value? It's a question that really challenges us to think about what value even means in our complex global economy.
You know, what do you think about a massive global company?